On today's episode, we are talking about exemption certificates. Certificates are low-hanging fruit in an audit, so it's important to understand how they work and what actually happens during an audit. It's also important to understand why a vendor might refuse to accept your certificate and why that actually might be a good thing. We'll also talk a little bit about some of the mistakes that businesses often make with these certificates. We also dive a little bit into how Wayfair really created a minefield for compliance when it comes to setting a tax practice or a tax process, why it's so important to ask specific questions, strategic questions, and why set and forget it is a very dangerous practice. You're listening to the Sales Tax People podcast. Here's the question. When I'm purchasing a product from a vendor or supplier, and I'm the retail company, right? So I'm reselling that product to the end user. The most correct way to do that is for me to provide a certificate to my supplier. I don't pay tax on those transactions. And then I have these products that I purchased exempt from tax, and I go sell it to my customer and I charge them tax. That's then, of course, the tax that I report to the state. Okay.
Right off the bat, I'm going to say yes. That is the most straightforward approach in sales tax. You provide
Beautiful.
a resale certificate. Some people call it an exemption certificate, right? Just to clarify, purchasing something for resale is very normal in the sales tax world. The states only want to tax one consumer. It's usually the end consumer. It's usually the person that the item's being sold to last, or the person who's using that product in a taxable manner. So if I'm a retailer and I buy products or materials or inventory that I'm going to process further or just directly resell to an end consumer, the best way to avoid the tax on the purchase of that transaction is to provide a certificate indicating that I'm purchasing this item to resell to another person.
Yeah, the other scenario that comes up for a company like that, and I'm going to talk specifically about, say, like a managed services provider that purchases hardware, right? Let's say laptops, and then they purchase those exempt from tax, and then of course that inventory that they now have or these products are then resold to their customer along with the services they provide. Now, what if I end up using one of those laptops because I hire a new employee and I say, here's a laptop for you? What's the most correct way to handle that?
That is a great question. That's a great question. Paul, do you have an answer for that? I think I have an answer for that.
100%. You purchase tangible personal property in this instance that's subject to sales tax, but you purchase it exempt from tax based on a resale certificate that was provided. You then used and consumed that tangible personal property. Therefore, you owe a use tax on what you used and consumed because sales tax was not paid upon the purchase of it. The idea that when you originally purchased that computer for resale is that you were going to collect the tax from the customer who purchased it, who ultimately used and consumed that laptop. But you didn't, and therefore you used that laptop, therefore you owe the use tax on that transaction rather than the sales tax that would be due on the sale of the laptop to the
I
consumer.
concur. I concur
Same.
with that
Same.
answer. Same. You would self-assess and remit that tax to the jurisdiction where you use that item. So just to clarify, I bought this item from I'm in Dallas right now. I bought this from someone in Oklahoma. They shipped it here. I bought it for resale. I have customers all over the country, so I could ship this anywhere. But because I used it in Dallas, then I need to self-assess and remit Dallas sales tax, Texas state sales tax to the state comptroller for that tax-free item that I pulled out of inventory and used for myself.
Okay. How about if that laptop, instead of you using it yourself, you hire an employee in Arizona and you ship the laptop to the employee in Arizona? What would you do in that case?
Straight to jail. Believe it or not, straight to jail. Just kidding. That's only if you're fraudulent with sales tax. You could go to jail. Paul? see if you concur with this. I'm going to say you want to self-assess and remit Arizona sales tax on the value of that laptop.
In general, yes, tax is due based on where it's used. Now,
should you self-assess and remit tax based on the retail value of what you would have sold it for, or on the amount that you paid for it?
definitely on the amount you paid for it.
I concur.
I concur.
Now, the question where you'll get into some deep water is what constitutes or is defined as use?
Wait, one question. How deep?
Real deep, depending on the state.
I can't touch. I'm treading.
Yes.
Okay,
better
I'm
know how to
nervous now.
swim.
Yep.
Because some states will indicate that the use of that product was actually when it was in your location, depending on the state. So it could be used when you take it out of inventory, and that constitutes a use, and therefore that state wants the tax due then and
So you're
there.
saying Texas would want tax because it was in my office or warehouse in Texas.
I do not concur because
Potentially.
Texas, and I don't know about other states, they have what's called a temporary storage provision, which means you can store product. That does not indicate a use of it. Oh, look at that confetti.
Yes.
And so when you remove it and ship it, then the tax is not due on removal. It's due where the item resides. Now,
Yeah.
this can get real complicated if you say,
It already
okay,
did. It's already real complicated.
if
But
you
keep going.
say, when I remove it from inventory, taxable, straight to jail, taxable, I pay Dallas tax, and then I ship it to Arizona. Arizona says, hey, taxes due
Taxable.
here for that item that came into our state and that's being used in our state. Most states, when it comes to use tax, have a reciprocal credit, meaning you only would owe tax on the value of tax larger than the tax in Dallas. So
Correct.
if my rate is 825, and I don't think Arizona's rate is larger than that, but let's say it was 10%, then you would owe another 1.75% to Arizona on top of what you paid to Dallas. But in general practice, if you bought something from another state, held it in this state in inventory for sale to your customers around the country, and then you actually shipped it to an employee in another state, then you're going to self-assess and remit the tax in the state where the laptop was shipped and where it's being used.
Yeah.
I just don't want to trip people up by, well,
Right.
what do I do? Who do I call? What state's tax do I use? You're not going to be hit hard because you self-assessed and remitted Arizona instead of Dallas.
Yeah.
And even the fact is, it may not even be observed, even under audit, what that situation was.
And here's another example within the same model, this business model. If I purchase some products and it's a part of a program, or for some reason like that supplier just refuses to accept a certificate, because we talk about that all the time, right? There's the correct way to do it. There's what the states expect when it comes to certificates. And then if I'm purchasing from, for example, a large supplier, sometimes I'm just at their mercy, right? They might just say, look, we just charge tax when we ship to Texas, right? Or to our clients that are not a part of this special program or whatever it may be. So if I purchase these products and I pay tax on them, let's talk about you, Par, right? Because we were already talking about Texas. So you buy the products, you ship them to your office there in Texas, but this specific supplier charges you tax, right? So let's say, using specific numbers just to make it super clear, you pay $100 for that product plus $10 in tax. Of course, that tax goes to your supplier. They're the ones that report it to the state. Now you have, during the given month, you have $100 worth of tax that you collect from your customers in Texas. Okay. Can you take that $10 as a credit against the $100 of tax you collected and only report $90 to the state of Texas?
Yeah, 100%.
No,
in Texas.
100%.
In Texas, you can do that. In New York, you can do that. But in most states, almost all the states, you cannot do that. Texas is just an unusual state in that it will allow you to take a credit for tax you paid on purchases erroneously against the taxes that you remit to the state on your sales. So unfortunately, you chose a difficult state because it's only allowed in Texas
Yeah.
that you can do that. Typically, what you would have to do is you would have to go back if you'd have to go back to the vendor, and you would have to get a refund from the vendor. If the vendor won't refund you, right? It's a difficult vendor, whatever the case may be. In this case, I would get a different vendor, that's for sure. But they're saying no. Okay, fine. You won't give me a refund. Then what I want to do, because the vendor is the one that has the right to that refund, because they're the one that collected it and remitted it to the state. So most states will only give tax back to the party that remitted it to them. So if they won't give you a refund, then you can plead with them to give you what's called an assignment of rights to the refund. And if they'll sign off on that, then you as the vendor could go back and get that money back from the state, indicating that, listen, the vendor erroneously collected it from me. It was a sale for resale. I paid the tax. They won't give me the tax back, but they've given me this assignment to the rights, to the refund that is typically theirs, but they've assigned it to me. So there is a process, but you still have to work with that vendor to achieve the end result. What's beautiful in Texas, if you're registered in Texas and you're remitting tax to Texas, you can just credit it against your own remittance, which is beautiful. On the other side of this transaction, I don't have Nexus in Arizona. I'm not worried about collecting tax from that customer. Let's say I do have Nexus in Arizona. And to your point, you brought up an example earlier. Hey, I paid $10 to my vendor on the sale of that item, so I'm just going to pass the tax through as a reimbursement, and I'm going to indicate it as a sales tax reimbursement for tax I paid on your behalf. Never, ever, ever, ever do that. Believe it or not, straight to jail. Don't do that. And here's why. Honestly, you're not going to go to jail. But what's going to happen is you're going to have done that, and Arizona's going to see that as a tax line item on the invoice, and they're going to have expected that that tax would have been remitted to them. So now you've reimbursed yourself for tax you paid erroneously because you didn't go get it back from the right party. You reimbursed yourself, but what Arizona sees is a collection of tax that wasn't remitted to their coffers, and now you're going to have to pay it to them with penalty and interest. Never, ever, 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 ever put anything that says tax on an invoice where you're trying to reimburse yourself for tax that you may have paid.
Yeah, if you need to reimburse yourself because you need to maintain your margin, right? Because you need to, you paid $100 and you're charging 200, and you want to make sure you get $100 of gross profit. But oh shoot, I paid $10 of tax, so I gotta pass that through to the customer. Go ahead and add $10 to their invoice, but call it something else, please. Don't ever call it
Don't
tax.
even do that. Don't even do that. Go get your money back from the people who erroneously collected it.
Well, I'm just saying if there's that's kind of their business model and they just need to maintain margins, it's like you better just charge $110 when you're selling your product to your customer. Is what I'm saying.
If for some reason you've allowed yourself to pay tax on items that you're reselling, then you just need to increase the price if you're not going to collect tax from your customer. But
because it becomes the cost of doing business, right? That's just your
Just
cost
into your
if you cannot do it, the correct way.
So some people will do that when they don't understand the tax regulations in place today, right? They don't recognize that they're creating Nexus in these other states, and they're running a model by which they don't want to have to collect tax, so they're paying the tax. They're not able to claim it for resale. They've increased the prices, or they've done whatever they need to do from a business standpoint to be paying the tax out of their own pocket and not collecting it from their customers. But the end result is they're going to establish Nexus based on thresholds in those other states, And if they don't go ahead and just comply with the law, register and start collecting tax and filing certificates for resale to their vendors, then they're going to be paying that tax out of pocket. And then they might pay it out of pocket again to a state where they should have registered, and the state comes in and audits them. But now they pay it out of pocket with penalty and interest. So the best case scenario is just understand that in the current landscape, post 2018, post Wayfair, tax and Nexus is based on where your customers are located, not just where you conduct your business. We preach that every day, and we still come across people that say there's no way that other state can require me to register. Well, post Wayfair, absolutely they can, as soon as you pass their economic thresholds or transactional thresholds. And it doesn't mean physical nexus has gone away. I mean, if you're in that state in any way, even with third-party contractors or reps selling on your behalf, you're creating a situation, if you don't go ahead and comply and follow the basic premise of what you opened with, Danny, which is, if I'm a retailer and I buy items that I resell to other people, then I need to buy those items tax-free by providing a resale certificate to my vendor. And where I have exceeded economic thresholds where I ship those items, I need to be collecting tax from the end consumer and remitting that to that state.
What do you guys think in other states? Let's take California, because it's a big state. It's usually, one of the biggest, if not the biggest, revenue states for a lot of companies that are doing business across the US. So taking this same type of, business model, what do you think a company would face in California if they pay tax on some of these items? So let's say it's Paul, right? Paul has a business. He's located in California. So he's buying and shipping laptops to his office there in California. And sometimes, again, for some of these reasons we discussed, he pays tax. Okay? Even though we don't want him to, we want him to do it the right way. It's just one of those things where when he buys from certain vendors, he cannot get around paying tax. And for some reason, it's still worth it for him to do business with that vendor. Okay, so he has these transactions. He's paid tax on them. And he says, you know what? I know this isn't the most correct way to do it, but it's a practical approach for me. So I'm going to, in fact, take this tax that I pay on these products, and I'm going to credit it towards tax that I collect from my customers, and ultimately am going to report to the state. So let's say I have $50,000 over some period of time that I collect from my customers, and I have about $10,000 during that same period that I've paid tax on when I purchase these products. So over that period of time, I only pay $40,000 to the state of California. What do you think is going to happen if the CDTFA
This time I'm not kidding.
audits me?
This time I'm not kidding. Believe it or not, straight to jail. But I'll let
I can
Paul.
tell you're kidding because we're laughing, but yeah.
I'll let Paul respond to that.
California is another bad example because they have a line item on the first page of the return that allows you to credit for tax paid on purchases.
No, it's a good example. That's why I asked California, Paul.
Yeah, so
that was a test, Paul, which
you would specifically line item that on the return. Hey, I've made these purchases subject to this amount, and I paid this tax, and it credits it off. But in Indiana and Massachusetts and Alabama and all the other states, it's not one that you can report it that way. So if you're going to back into that number, hey, I collected 50 grand, I paid 10 grand, I'm only going to remit 40 grand, and then you back into your taxable sale figure from that 40 grand number. Then under audit, you just want to make certain that you can substantiate. Why did you collect 50, but you only paid 40? Well, back of the envelope, I just took a credit right now for the tax that I paid in error, and I captured that in the moment. Under audit, depending on your auditor, that could be not appreciated and approved, and they could just right off the bat just deny it and impose the tax with penalty and interest on top of it. Depending on the state and the auditor, they could slap your hand and say, don't do that, and still allow you to report it that way. Or they could force you to amend the return, report it correctly, and then request a refund, depending on the state and the process to obtain the refund, whether that is through the vendor or through the state directly. Each state has the ability to govern that process uniquely, and themselves. It's why small and medium-sized businesses are frustrated with the states and their varying legislation. That's why the streamlined sales tax was put together to try and combine some of those efforts and definitions and processes. But yeah, it's quite frustrating.
Needless to say, it's frustrating and complex, and the answer to any of these questions is oftentimes, if not always, it depends on the state.
But there are remedies. There are remedies.
sure.
You just have to be
Definitely.
careful what remedy
Definitely.
you choose. The best remedy is to provide a resale certificate and
Yeah.
comply.
And the best advice I could give anyone is get multiple opinions. Right? It ties right back into something we like to say a lot is it's a parism, as we call it. We want to be your first, second opinion. Like it just makes sense to take some time and get on a call with experts and get opinions and certainly get opinions from experienced experts, right? People that have been doing this for a long time. And because there's always a cost benefit analysis, right? We talk about materiality and how meaningful the exposure or the benefit is, right? Even the example of if you're buying those products and they have tax on them, well, if it's more of like a one-off purchase for your business and it's not, a regular thing, then it might make sense because maybe you just got such a good deal on them, and even paying the tax on it, maybe it's less than you would have paid otherwise, right? So there's plenty to consider, and always the thing to consider is understanding what's most correct, understanding the options you have, doing a cost benefit analysis, and certainly get opinions, right? Don't just think you can
Right.
set something up and, set it and forget it, as we say. And it's always important to have a discussion around it. And it's always worth it to take some time initially to get it right, especially as your business is growing and, you have different things popping up for your company around vendors and certificates and that leads to a whole nother discussion that we've had before, and we'll have another time around certificates and just how they're low hanging fruit. So, I bring up a possible audit and what would happen in the audit. Well, anything you're doing along resale provisions, certificates, credits, like that's going to be low hanging fruit to the auditor. So it's certainly
Yep.
worth getting an opinion on that sort of thing.
Yeah, especially when you're claiming resale is pretty common. Still has to be documented with a certificate, right? If you're a vendor accepting certificates, you want to keep those certificates on hand because you always charge the tax, and the only time you don't charge tax is when you have a certificate in hand, right? But when you're claiming an exemption that maybe is not resale related, right? It might be the type of organization you are, it might be how you use an item, or what you're going to do with that item. Anytime you're claiming those exemptions, you want to maintain those certificates. In any audit scenario, that's always low hanging fruit, to your point, Danny.
Yeah.
And we don't want anybody to go to jail.
Thanks for hanging out with us on the Sales Tax People podcast. If you want to talk about sales tax, or maybe you have an experience that goes along with something we talked about today, or maybe you just want to hear about how Paul's day is going, make sure you send us an email to podcast@sales.tax, or you can text us at 949-355-5098. See y'all again soon.